Hi, I'm Tara Umversat. I am owner and senior lead planner here at South Bay Financial Partners. And I was watching a reel the other day that Dave Ramsey put out where somebody had called in and asked him about infinite banking. And I won't go a lot into the infinite banking part, but basically it's a whole life program that insurance agents sell as a way for you to have money in retirement. And actually, specifically, you buy it for your child at birth and you don't pay very much money, and they end up with an infinite bank account that they can use in their retirement. So that's the pitch. And Dave Ramsey did a great job explaining about some of the misconceptions with that. But I felt like he missed a key point. And so I wanted to talk about just one aspect of infinite banking that he sort of touched on, but didn't go into as much depth as I would have liked him to. So I'm going to give you the numbers of what the case was, and we'll go over this. So the scenario was the caller said that he had bought a whole life plan for his baby when he was born, and he paid $5,113 for 13 years. And when his son was 13 years old, he had that account would be that insurance policy would be 96,544. So already he's thinking like he's a winner. He's only put $5,000 in for 13 years, and his baby now has a $96,000 life insurance plan. Woohoo! And his baby is 13 at this point. And he mentioned that at 15 years old, this child would have $108,000. I think it was something like that. And then he went on to say that at 88, his child would have $2.5 million. This is where the infinite banking comes in. So the insurance company is saying that your child, that you put this little investment of $5,000 for 13 years of premium in retirement, will have this $2.5 million that they can use to fund their retirement. And what they failed to say is that if this child at 65 retires and starts taking money out of this insurance plan, he is not going to have $2.4 million at 88. As soon as you start taking money out, that decreases the value of that account. And because the account is smaller, it's going to be growing at a smaller amount because there's less invested to grow. So if he doesn't touch it at all, he'll have that 2.5 million. But the whole point of the infinite banking is that at 65, he'll be able to spend for his lifestyle on that with that $2.5 million. But the fact is, if he starts doing that at 65, he could easily deplete it before 85, and he could completely lose insurance and have nothing at all at 88. So the person calling in had this conception that it was just going to continue to grow and grow and grow. And the fact is, it grows if you don't take any money out. But if you're planning on taking money out, that is when it stops to grow, and it could even get smaller, and it could even get to zero, and you could even default on it or have to put more money in to have that life insurance plan. So know that, first of all, if you take money out, you're not going to have as much as they're saying that you have. But also, the other point that Dave Ramsey was trying to say, and I didn't think he was necessarily 100% clear on it, is if you put that $5,113 in every year for 13 years into Vanguard Total Stock Market Fund, ETF, and just put it outside of an insurance plan into just a regular old index fund, and you let it grow at 6%. Dave Ramsey uses 8%, so his numbers are a little bit different. I use 6%. I'm a little more conservative. And the only thing we know about the future is we can't predict it. So you might get more or less than 6%. That's my disclaimer and caveat. This is for example only, and your results might be different, and it might not be the right investment vehicle for you, but this is just for education and an example of what you might think about. So if you get 6% return, putting in this $500,113 for 13 years, at 85, you would have $6.4 million. In that insurance plan, if you didn't touch it, if you didn't take out a dime, you would have 2.5. But if you put it into an index fund, you would have $6,400 at a 6% return. So it's 3 times more. In Dave Ramsey's example, it was 4 times more. however you slice it, whatever your return rate, you're going to have more than you do in that insurance program. And why is that? The reason why that is this $5,000 in that whole life plan is not going into investing. A big chunk of it is being taken out and paying commission to that agent that's selling it to you. So only 3/4 of this is actually going into investments. And therefore, you're having a smaller amount of money actually being invested and compounding until 88. And so the net result of what is left after fees is only $2.5 million. If you put it in an ETF that's a low fee, generic, well-diverse stock fund, that money isn't going to come out in fees, and you're going to end up with a lot more when you get to 85 years old. And this is at 85. This 2.5 million was at 88. At 85, you would be at 6.4. You'd be even higher than that at 88. So be careful when insurance is a great tool. It's a great tool for risk mitigation. So using insurance for risk mitigation, 100%, I'm behind it. I love insurance. As an investment vehicle for any purpose, usually not your best choice. So know that there is a time and a place for annuities and for insurance, but not for most people, not most of the time. It's really for a segment of population, for a small part of their portfolio being in one of those instruments can make sense. But for the majority of the people, the majority of your investments, it makes more sense to just invest it into straight up, no fees, nothing fancy kind of investment. So that's what we recommend. If you have any questions, again, come to our community, Your Amazing Financial Life. You can find that at YAFL. That's Your Amazing Financial Life, YAFL.southbayfinancialpartners.com. We'll have a link below. And please ask us questions, challenge us. We love that. We love to be in conversation and look at things from different points of view and to hear from different people. So we hope to see you in our community. Thanks.